First of all, thank you for all turning out here in the middle of August. We wish it was a duller middle of August. It's really a pleasure to be here today in northern New Jersey and have this opportunity to speak to members of the Meadowlands Chamber of Commerce. In the aftermath of the financial crisis, as we wound down some of our special facilities, I asked my staff to develop an ambitious outreach program so we could visit different parts of the district. And so this is part of that. We spent yesterday in Newark and Jersey City. Today we're here. We're going to make a number of other stops. And over time I plan to visit all parts of this region. These are important visits for us. It allows us to deepen relationships with the people that I represent. As you may know, the New York Fed District includes the 12 counties of northern New Jersey, all of New York State, Fairfield County, Connecticut, and Puerto Rico, and the Virgin Islands. In June, I met with community leaders, businesses, and elected officials in Brooklyn. In May, I was up in the mid-Hudson Valley, north of New York City, to meet with the leadership of those communities. And so today, we're continuing that process in northern New Jersey. And this is very important to meet and learn firsthand, what are the economic and financial issues that are most important to you. These conversations are important to me because they help me represent you when I go to Washington and consider exactly what's best in terms of managing interest rates and setting monetary policy. Northern New Jersey is also important to me. I have more than just a passing interest because not only is it an important part of the New York Fed District, I live here. I'm in Cranford, New Jersey. It's my wife's hometown, so that sort of tells you who runs things in our family. But we're actually there so we can be very close to her mother, who lives in the house still, where my wife grew up. In our travels, we're very pleased to work with the business community in vigorous, active chambers such as we have here. So thank you, Jim, for inviting us today. However, even as a wealthy state as New Jersey, there are pockets, and sometimes very large pockets, of poverty. So even though we do spend a lot of time with the business community, we also have a large number of initiatives specifically targeted to help low and moderate income groups. And we've worked particularly hard to help challenge cities such as Newark, where I was yesterday, and I had a chance to meet with the mayor, Cory Booker, and Newark Now, which is a very important group that's trying to push things forward in a positive way there. Now, as part of this efforts, for the past 3 years, we've been providing Newark Essex County Foreclosure Task Force with a lot of information, data analysis on the latest mortgage conditions and trends through roundtables, presentations, and newsletters. The task force was formed in late 2007 in response to the rise in foreclosures in Newark and surrounding towns. We've also partnered with the Bank of New York, which we visited, Bank on Newark, which we visited yesterday. That's a public-private partnership that's really been developed to bring unbanked populations into the financial mainstream by helping them establish bank accounts and receive financial education. But that actually understates what Bank of New York does. They have a number of other initiatives as well that are quite interesting. This fall, we're going to launch our financial awareness video competition in Newark and Essex counties. This competition invites university and college level students to produce videos to explain to young adults how they can make sound personal finance decisions. I thank the Meadowlands Chamber of Commerce for inviting me to speak here today. This is the second day, as I said, of my visit to northern New Jersey, and I think we have a very packed schedule, and I'm going to learn a lot just like I did yesterday. So by way of introduction, let me briefly review what the New York Fed does and what makes my job so interesting. And with that, I always have to have a little bit of a disclaimer, which reads, as always, what I have to say reflects my own views, and not necessarily those of the Federal Reserve System or the Federal Open Market Committee, also known as the FOMC. So I speak for myself, not for all my fellow committee members. I'm the vice chair of the Federal Open Market Committee, as Jim noted, and we meet 8 times a year in Washington to set interest rates and make other decisions on monetary policy. What happens at each meeting is each committee member presents his or her own current outlook for the region and for the overall economy. And as part of that process, not only do I lean heavily on the research staff at the Federal Reserve Bank of New York and all the economic data that's released by the federal government, But it's also important to talk to others, so the board of directors, regional advisory councils, and conversations with local stakeholders, such as the feedback I'm going to get here today. At the regional level, we do a lot of work. We continually track economic conditions in our district, and we've created a large number of tools for that purpose. For example, to fill a gap in timely measures of economic regional output, my staff produces monthly indices of economic activity for New Jersey, as well as for New York State and New York City. These measures are similar in concept to measures of national output, such as GDP, gross domestic product. We've also initiated a consumer credit panel, so we can actually monitor local household credit conditions, amount of debt being taken down by people, and what's happening to the status and composition of the debt over time. We can actually take that down to the zip code level. Furthermore, we have a new survey to track credit and financing decisions for small businesses. Small businesses are particularly important because they create a lot of jobs. And it's a challenging environment for small businesses right now because credit is a little bit harder to come by than it has been in the past. This poll takes a fresh look at small business borrower demand by asking firms not only about their credit applications, but also the reasons for those who are not seeking additional credit. In all, in our most recent poll, May of 2011, we had 876 small businesses respond from the tri-state region, and a good portion of them were from New Jersey. Now, we collect all that information, so what do we do with it? Well, we actually share that information we gather about our district, and we actually have a very rich website which has all the current localized current data and maps on conditions in this region. So if you really want to know what's going on in the region, you can go to newyorkfed.org, our website, to explore a lot of this highly detailed information about small business, credit, and housing conditions in our region. Now, we do spend a lot of time on the regional and national economy in terms of thinking about the economic outlook and monetary policy, but it's also important that we also think an awful lot about financial stability. In the aftermath of the financial crisis, we are working with our colleagues in Washington, D.C. and other regulatory agencies in the United States and abroad to put the nation's financial system on a firmer footing. We've done a lot. We've made a lot of progress, but more needs to be done, and we're determined to keep at it. I recognize fully that there can be no return to pre-crisis business as usual, whether on the part of the financial sector or on the part of regulators like ourselves. So as you can see, all in all, even in normal times, we have plenty to keep ourselves busy. So now let me talk a little bit about the national economic outlook, and then I'll get into what's going on here in New Jersey. The statement we issued at the Federal Open Market Committee last week following our meeting presented a sober assessment of the state of the U.S. economy. Economic growth so far in 2011 has been quite a bit slower than what we had expected at the beginning of the year. While job growth did pick up earlier in the year, in the last few months, conditions in the labor market have deteriorated a bit, and the unemployment rate has edged back up. Household spending has flattened out, and the housing sector remains depressed. Business investment in equipment and software is expanding, but investment in corporate offices and other commercial buildings is weak. Now, some of the weakness in economic activity in the first half of the year was due to temporary factors such as the hit to household income that we've all experienced from higher food and energy prices, which has left less money left over to buy other goods and services. And the supply chain disruptions that we saw following the tragic earthquake in Japan have been very, very important in terms of disrupting automobile output. Now, the good news is that these special factors have abated somewhat, and so we should see stronger growth in the second half of the year. But at the same time, it's important to recognize that not all the weakness that we saw in the first half of the year can be accounted for solely by these one-time factors. And in light of that, I have revised down my expectations for the pace of recovery going forward. We're looking for growth of about 2.5% in the second half of the year. On the inflation front, the committee noted that inflation has moderated recently as energy and commodity prices have declined from their peaks after having picked up earlier in the year. The earlier increase mainly reflected the spike in commodity prices such as oil and imported goods, as well as the fact that auto prices firmed temporarily as there were less cars available for sale due to the supply disruptions from Japan. Longer term, inflation outlooks looks fine. Inflation expectations remain stable. And the committee now expects inflation to settle back down at levels at or slightly below those consistent with our mandate to promote full employment and price stability. Now, in light of the current outlook, the FOMC in its statement noted that we now anticipate that we're likely to keep short-term interest rates exceptionally low, at least through mid-2013. We also discussed the range of policy tools available to promote a stronger economic recovery in the context of price stability. Further details on the discussions that we had at that meeting will be available when the FOMC minutes are published later this month, and I'm not going to comment any further on monetary policy today. Following the release of the FOMC statements, market interest rates did move lower, which was good because that provides some additional support for economic activity and jobs. I would note, however, as we saw yesterday, economic conditions do remain unsettled, and the equity market in particular has been quite volatile recently. So now let me turn to New Jersey. How is our region doing? Well, let me start by saying that New Jersey is well positioned for growth. The state has a population of 8.8 million people. It's the 12th largest state by population. And despite the fact that this is a fairly mature region in the country, the state's population is still growing. It rose at 4.5% in the last decade. This is a well-educated state. Over 40% of the population, 25 years or older, have a college degree. That's 5 percentage points higher than the national average. And the population is quite diverse ethnically. Roughly 20% of the state's residents were born abroad. And that share is even higher in certain counties such as Essex and Bergen counties. Significant numbers of foreign-born residents in the state come in particular from India, Mexico, the Philippines, the Dominican Republic, and Korea. The state's economy is also quite diverse, and its industry mix mirrors the national economy. A sizable number of jobs in the state are in healthcare, professional and business services, wholesale and retail trade, and leisure and hospitality. While we look at the northern part of the state, we see somewhat greater concentration of jobs in finance, particularly in Hudson County, and also in goods distribution related to the ports, rail lines, and trucking and warehousing activities that are very prominent here. Also, pharmaceutical manufacturing and research development and private education. Those sectors are also very, very important. The area, of course, also has very important links to New York City. For example, the data centers here in the state serve many of the city's largest financial firms. And there are a large number of residents, including myself, who commute each day into New York City. And a smaller but still sizable number of New Yorkers reverse commute from New York back into New Jersey. So how did the state fare during the downturn, and how is the recovery proceeding to date? As I mentioned earlier, the New York Fed produces indexes of economic activity to help us monitor the performance in this region. And based on our index, the downturn in activity in New Jersey began about the same time as the Great Recession happened in the country as a whole. That's around December of 2007. Now, while activity in the state is no longer declining, and there has been a slight pickup this year in the level of activity, to date, there's still really no sign that a strong recovery has yet taken place. And quite frankly, the recovery in New Jersey is not quite as solid as what we've seen in New York City, which has actually had a relatively sturdy recovery over the past 18 months. Employment in our region also declined substantially during the Great Recession. Job losses in New Jersey, peak to trough, were about 250,000. That's on par with the roughly 6% decline in jobs that we saw nationwide. The pattern of job losses here in northern New Jersey was very similar to the state as a whole. In New York City, job losses were also large, but somewhat less severe, with employment in the city declining a little bit more than 4%. Now, we're finally seeing a jobs recovery in New Jersey, but to date it's been quite sluggish. The private sector is doing reasonably well, moderate gains, with growth in some of the key sectors that I noted earlier, particularly in professional and business services, educational and health, and leisure and hospitality. Businesses in these sectors, on balance, expanded jobs at a faster rate than for the nation as a whole. But the state continues to shed jobs in manufacturing and residential construction. And most notably, overall employment in the state has been weighed down by declines in public sector employment. Like many states, New Jersey faced large projected budget deficits during the downturn, and as in many states, the adjustments to the budget included job cuts through reduction in state government jobs, as well as cuts in local jobs as state funding to local governments was reduced. The weakness that we've seen in state and local government employment in New Jersey is actually more pronounced than for the nation as a whole, and that's something that's been holding New Jersey back. Because the jobs recovery has been weak, there has been little progress in reducing unemployment. The current unemployment rate among New Jersey residents is 9.5%. That's about the same rate as a year ago, and it's slightly above the national average. Now, underneath this slow overall job growth picture, there is a considerable amount of churning in the labor market. And if we take a closer look at the patterns of job gains and loss during the recession recovery, it reveals some interesting facts about the labor market that we have in New Jersey. Of particular interest is that job creation in the state and the nation since the recession has been closely balanced. The recovery has been closely balanced between hiring into industries that lost jobs, so people that were laid off coming back to work during the recession, versus hiring into jobs in expanding industries, so new jobs. So what we see is that many unemployed workers may be returning to jobs without needing to retain or look further afield for the jobs they lost. However, an equal number, many need to search outside the industry they know best, and this may require retraining in some instances. Thus, I think the need for job search assistance and training opportunities is likely to be high in New Jersey as in the nation as a whole. So now let's look at the situation for New Jersey households. The median household income among New Jersey families is the second highest in the nation. It's $68,000 per household in 2009. And about 9% of state residents are in families with incomes below the poverty line. That actually compares favorably with the national rate of poverty line of 13.6%. But that obscures a lot of variation by city across the state, and there certainly is plenty of room for improvement. Even in such a wealthy state as New Jersey, there are pockets across the state characterized by a sizable number of people lacking a high school diploma, unemployed, and living with poverty. Reducing poverty is clearly a major challenge for policymakers. Where we were yesterday in Newark is really one of the more troubled areas, with a lot of challenges ahead. But I really was quite pleased to see how broad and deep the efforts are there. More broadly, how are the state's families doing in terms of restoring their finances? During the recession, all across the nation, the number of debt delinquencies soared, and many families had found that they had to reduce their debts to a more sustainable level. The New York Fed, as I noted earlier, keeps track of credit conditions in the region, including the average debt carried per person and whether they're current with their payments. And we developed this data using a special consumer credit panel we developed. The report for the second quarter of this year just came out this last Monday, so it's pretty current information. Families in New Jersey are reducing their debt levels. As of the second quarter of this year, for example, the average debt per person for those people that actually have a credit report was down to $60,400. That's down from $63,000 3 years ago. But the crisis has clearly taken its toll. Delinquency rates on this debt are high. 77.4% of all debt in the state is seriously delinquent. That's about the same rate as for the country as a whole. The comparable figure for the state just 3 years ago was 4.1%. So we've gone from 4.1% to 7.4%. And what that indicates to me is that households in the state, just like for the nation as a whole, still appear to have a considerable ways to go before they reach debt levels that they're really going to be comfortable with on a sustainable basis. In terms of housing prices, there have been some indications that home prices in the area have flattened out and maybe even ticked up in the past few months. Nevertheless, the mortgage crisis continues to take a toll on New Jersey homeowners. As of March of this year, 10% of all borrowers in the state were either 90-plus days delinquent on their mortgages or their homes were in foreclosure. That's higher than the national average of 7.7%. In Bergen County, the rate is close to 8%, so pretty close to the national average. In terms of small businesses, in our recent small business survey, we asked firms to report on their first quarter sales and their future outlook. Here, the results were actually quite encouraging. Over 2/3 of the firms told us they had stable or increased sales in the first quarter. That was up from 50% last year, so an improving trend for small businesses. When we asked about their future outlook, while the majority of business owners, 56%, were neutral, of those that were optimistic versus pessimistic, it skewed very, very sharply to the optimistic side. 37% optimistic versus only 7% that were pessimistic. So let me sum up. These debt and delinquency figures, together with the week's job picture, suggest that New Jersey continues to face a number of challenges. In the near term, the key issue will be to expand jobs and reduce unemployment. At this point, it's difficult to say when the pace of recovery in the state will pick up, but there are several factors that are encouraging. A continued expansion of output employment nationally would clearly help to expand activity and employment in a number of industries in the state, including professional and business services and in the goods distribution industries. Also, it's important to note that the pace of contraction in public sector jobs in the state has slowed from the sharp declines that we saw last year, and has thus become less of a drag on job growth. So we can expect now to see the private sector jobs overwhelm the public sector job losses. That will be helpful looking forward. Further, continued job growth in New York City should create opportunities for New Jersey residents, particularly in this part of the state. Longer term, one of the key challenges will be for the state to build upon and to expand its citizens' human capital. By what I mean by human capital is the education and skills of its workforce. At the end of the day, a region's human capital determines a large part of its economic success. Even though we already have one of the most educated workforces in the country, New Jersey still needs to do more to continue to attract and train workers so that they can do the wide range of tasks that an advanced economy demands, start innovative firms, operate sophisticated capital equipment, incorporate new technologies, design new websites. As Marcia said, you can do a lot with the web. In addition, a broad expansion of education and skills goes a long way to help broaden the participation in the economy to all the residents in the state. Thank you very much for coming today and for your kind attention. I'd be happy to take a few questions.
Okay, who's got a few questions? Come on. Not often we have the president of the New York Federal Reserve Bank right here in the Meadowlands, so please, in the back.
How much do we have to worry about the European banks?
There was an article in the Wall Street Journal yesterday that talked about the New York Federal Reserve monitoring the European banks. The reality is we monitor European banks and U.S. banks every day. So there's nothing to be particularly alarmed about that. That's a normal standard operating procedure. We're looking at our banks, European banks, basically because of the turbulence that we've seen in financial markets. It's prudent for us to make sure that we understand what's going on and to monitor the banking industry's situation. I think the good news, I think that's a really important thing to underscore, though, is that the banks are in much better shape than they were several years ago. Capital levels are much higher. The quality of capital is much better. Credit quality at the banks is improving. And the banks have huge liquidity buffers compared to what they had in 2008. So, there's some stress in the system right now. There's a little bit of stress in the system, but we're in much, much better shape than we were back several years ago. We've been working on this for several years, and I think we're in pretty good shape. The question is, what policies can the Federal Reserve implement to bring the unemployment rate down by November 2012? Well, I can't promise that our policies are going to achieve any given outcome because life is unfortunately uncertain. All I can say is that we are doing pretty extraordinary things to make monetary policy as supportive as economic activity as we possibly can. And we do think it will lead to recovery in the economy, improvement in the labor market, and a decline in the unemployment rate. I think up to now we've been disappointed by how rapidly the unemployment rate has come down. We've seen some declines over the last couple of years, but the unemployment rate today is clearly much higher than what we want to see. So we're going to keep at it. We're going to continue to try to support the economy consistent with our dual mandate of trying to achieve full employment and price stability. Obviously, what we do will depend on how economic conditions evolve. Well, I think the commercial real estate picture is there's some things that are better and there's some things that where there's plenty of room for improvement. I think that's better is The real estate market, the securities prices of commercial mortgages, have improved. I think financing is probably a little bit more available today than it was a year or two ago, but we're clearly not back to business as normal. Part of the problem, of course, is the economy. If we get more job growth, that'll create more demand for commercial real estate, and then with that, you'll start to see, I think, more improvement. Right now, the commercial real estate market, I think, is a little bit bifurcated. Trophy properties, in downtown, in midtown New York City are quite a bit in demand. But as you move away from, the central cities in prime locations, commercial real estate is struggling a bit. So it's better than it was, and I think what we'll see is a gradual recovery. But I think at the end of the day, it's really going to be tied very much to the overall economy and what happens to the labor market. Well, I think the reason why we think that things are going to pick up is, one, we actually see, there's been a lot of anxiety in the markets over the last couple weeks. But if you look at the data, it's actually at worst mixed. We got industrial production report for July, for example, that showed industrial production up 0.9%. That was a very important report because it really sort of confirmed, at least to me, that the disruption caused by the Japanese earthquake to automobile production in the United States was really ending, and so automobile production was really going to pick up pretty sharply in the second half of the year. Retail sales, the report we got for retail sales for July were a little bit firmer than expected, and there were actually some upward revisions to prior months. The other thing I think that's important to recognize, so some of the temporary factors that have been holding us back, we think are abating. And the second thing I think is to recognize that underneath the surface, there's a slow convalescence going on. Slow convalescence going on in terms of household finances, convalescence going on in terms of the health of the banking system, the willingness of bankers to lend. We do a survey of bank lending conditions, and what we've seen over the last year is just a gradual improvement. It's now I don't want to argue that credit is readily available and bankers are throwing money out the door. I don't think that's true. But credit conditions are gradually loosening, and it's that change in credit conditions that matters in terms of economic growth. So I think beneath the surface, we are having a convalescence. The convalescence is certainly a lot slower and longer than what we had hoped for, but I think that we're very most likely, assuming there's no sort of big shock to the economy, on a pattern of economic recovery. I don't think that you have to be worried about that. The Federal Reserve, the Federal Open Market Committee, I don't normally speak for my other members, but here I will speak for my other members. All the members of the FOMC are completely committed to keeping inflation under control over the medium to longer term. And as I would note, that inflation expectations are very well anchored. There's no sign of any uptick in long-term inflation expectations. So I think that shows that people are confident that we're going to do our job. In terms of the downgrade, I think that it's very clear that the U.S. has more to do in terms of the long-term fiscal outlook. That's challenging in terms of deciding how to do it. Congress and the administration made a little bit of progress in the run-up to the debt limit ceiling, so there's now a down payment on that fiscal consolidation. But more needs to be done, and I think some of the rating agencies at least want to see more tangible proof of progress on the long-term fiscal outlook. That's important to them. Well, I think that at the end of the day, if you look at how markets have behaved, I think markets have behaved with a very resounding vote that the U.S. will honor its debts over time. Full stop, no doubt. Remember, the downgrade was from AAA to AA+ by one credit rating agency. So I think it's important also not to overstate, the significance of the downgrade. And it was really more on the basis of the fact that, haven't seen enough yet. I'm absolutely convinced that we're going to do what we have to do over the medium to longer term. What I'm uncertain about is how, bumpy that path is going to be and how politically difficult that path is going to be to get there. The markets, I think, have no doubt that the U.S. is going to repay all of its debts. Well, I think you have to distinguish between small business owners that are well established and have a good track record versus smaller businesses that maybe struggled in the recession or or people who want to start up new businesses, but actually don't have the business up and running. I think we talk to a lot of smaller businesses, and for those who are up and well established, we find that they're actually doing pretty well. They basically have access to credit in most cases. But when you get to businesses that had a more bumpy ride during the recession, and so their credit record is not as pristine, for them I think it's more difficult, and it's particularly hard for the startup company. We went back and looked at how do startup businesses actually get financing to start their businesses. And we found that there are actually three major sources: family and friends, credit cards, and home equity lines. And we saw that the banks tightened up, their credit limits on credit cards. They've brought them down quite a bit. And obviously, home equity loans, lines of credit, are obviously affected by the decline in housing prices. So the area where you really are probably seeing the biggest effect on small businesses are the small businesses that just don't even happen because they can't get the credit to actually start up. So that's really a real challenge. And it's hard to ask a banker to, make a bet on with a business with no track record, and so you can sort of understand why some of the bankers are reluctant just on the basis of a business plan to provide financing. So that's a challenging constraint on the economic recovery.
Yes, Tony?
Well, I think one thing the government I think plays a huge role is job assistance, job retraining, support for education. If you have a well-trained workforce, you're probably going to have a highly employed workforce. We compete in a global economy, and at the end of the day, if we have well-trained people who have good skills, they're going to find things to do and they're going to gain employment. So I think the government's role is very much in that dimension. Could the government, develop other incentives for businesses to hire? Certainly, that's something that it's certainly possible. It's certainly possible. I mean, the challenge of that, of course, always is how do I develop a tax credit or a payroll tax rebate that provides the incentive for the business to hire the person that they weren't going to hire, as opposed to just gives them money for the person they already were going to hire. So it's very hard to design these things to really get at that incremental hire that wouldn't have taken place without the incentive. So so there's some challenging design problems in terms of developing those kind of.
Have you got a peek into the president's proposed jobs plan?
No, I have not.
Yes.
Yeah, the Fed is under a lot of pressure from the right not to do too much, like quantitative easing, and how do you handle that pressure? Do you feel that?
Well, look, the Congress, in its wisdom, decided that the U.S. should have an independent central bank with respect to conducting monetary policy, and we consider ourselves independent. And the reason for being independent is it allows you to follow the monetary policy that you think is right, regardless of short-term political pressures. So we feel independent. We're going to conduct monetary policy in an independent way, and that's the way Congress wants it. And so we're going to do our duty, regardless of what happens in the political realm.
Bill, I have one, if I may.
Sure.
We have organizations like ours have great collaborations with entities like the Meadowlands Commission and local economic development entities. Have you seen with any of your associates from other parts of the country any collaborative initiatives that are meaningful to help the economy and small businesses without necessarily the need for government assistance like that? Is there any models out there that are working that you've seen that we perhaps need to take a look at so we can help our business members?
Yeah, I am not the most knowledgeable person at the New York Fed to answer this question. Ray Rosen of our staff would be able to give you some of the more novel partnerships between government and business. I think what I will say, sort of in a general sense, is what we find oftentimes is a lot of it is about coordinating the flow of information. There are a lot of programs out there that are available to people, and a lot of it is just about getting the information out. I mean, one of the discussions we had yesterday in Newark was just about how do you get people to be aware of the government programs and other programs that are available to them. So one of the initiatives in Newark was getting people to file the tax returns so they could actually get the money that was owed to them by the government. There are people in Newark who were leaving money on the table because they just didn't know how to actually file tax returns. So there's things like that where, there are programs available, and I think a lot of it's about getting the information out so that people can take advantage of them.
Great. And I know Ray for a long time, so I will have that conversation. Thank you. One last question, anyone? Yes.
How much of the contraction in credit lending do you feel is attributable to unintended consequences, maybe from Dodd-Frank, or the definitions and QRM, things like that, or prohibiting banks from actually lending?
How much contraction in lending do I think is due to the Dodd-Frank Act and other increases in regulatory burden? I think de minimis. I think it's dramatically overrated. I think the banks will be able to conform with the higher capital and liquidity standards that we're putting in place, reasonably comfortably. We did not ask the banks to raise a lot more capital instantaneously. This is phased in over a long period of time. We do think it will have some effect on their profitability. It might also have some effect on the level of compensation in banking. But we think that there's lots of margins of adjustment, and we think at the end of the day this is not going to have any significant constraint on the economy or on lending. So it's not something, in all my concerns, this is way down the list.
Ladies and gentlemen,
Okay, thank you very much.